Much of our understanding of monetary policy and money supply is about to change. You thought that a bank can give loans only to the extent it has deposits? Wrong. We thought that if a central bank keeps excess cash reserves, liquidity in the banking system, more loans can be given? Wrong again. Says who? A new book. It's called Money, a Zero-Sum Game, authored by K.V. Subramanian, that's India's former chief economic advisor, and his colleague K.V. Vaidyanathan, another bright young economist. The book has hit the stands and it is about to challenge many mistaken notions and theories in monetary economics. Well, with this intro, let me welcome the author himself to explain the theories in his book. Joining me is Dr. Krishnamurthy Subramanian, one of the authors of the book. Dr. Subramanian, thank you very much indeed for joining us. Well, first up, why have you written this book now? Are you seeing too much of wrong policies?
First of all, thanks a lot, Lata, for providing me the opportunity to talk about the book. Back, during the financial crisis, since then, my co-author and I, we've been observing central banks across the world pull out many unconventional techniques to try and stimulate the economy, to increase bank lending, increase growth. What we've observed is that many of these so-called bazookas that central banks across the world have pulled out have actually turned out to be damn squibs. Even during COVID, again, central banks across the world tried to do more of the same. So when we, started thinking about why is it the case that a lot of these measures that central banks have attempted, and if you notice, many of their balance sheets have multiplied, many times over, yes. And yet, they've not stimulated the economy. So we started thinking deeply about this, and what we found is that the monetary theory that draws, that guides policy, monetary policy itself is flawed. And that is why we are writing this book, one, to point out the flaws in the monetary theory, and second, to provide a new framework that is practical enough to work.
Okay, now let me take theory by theory that you demolish. The first flaw that you point out is the concept of money multiplier. Now, how did we understand money multiplier back in the college days? If CRR, cash reserve ratio, is 4%, that is 4 by 100, money multiplier is ulta, it is 100 by 4, that is, it should be 25. Now, just for those who have not gone through the economics class that I went through, if you have a deposit of 100 rupees, the bank has to keep 4 rupees as cash. It can lend 96 rupees as a loan, which becomes somebody else's deposit. Then it takes out another 4 rupees, and then it lends 92, and so on. It can do 25 times. But you are saying it never works that way. Tell us how.
Yes, yeah, you very nicely explained how the concept of money multiplier works. This is one of the key multipliers in economics. There's also what we, for instance, call the consumption multiplier in macroeconomics, and you described it very well. It is a combination of deposit and loan transactions, in the economy that actually lead to the, to the multiplier. Now, as you rightly pointed out, monetary theory tells us that the multiplier is the reciprocal of the reserve ratio. Now, notice there is no other variable in this particular multiplier, just the reciprocal of the reserve ratio. What would that mean then? That if the reserve ratio is decreased, then the money multiplier should increase. If the reserve ratio is increased, then the money multiplier should decrease. And if the reserve ratio is flat, actually there should be no change in the money multiplier. Yet, when you look at the real world, take the global financial crisis. All through the global financial crisis period, almost 5 years, the Fed, for instance, the US Federal Reserve is the central bank for the United States, did not change the reserve ratio at all. And yet, during that period, the money multiplier in the United States declined from about 9 to 3. No change in the reserve ratio, and yet money multiplier goes from 9 to 3. In a similar way, if you look at in India, during the global financial crisis, the Reserve Bank decreased the money multiplier from 9% to 5%. So what would monetary theory tell us? That money multiplier should basically increase from about 11, which is reciprocal of 9%, to 20. And yet what you find was during that period, money multiplier was nowhere close to either 11 or 20. It ranged between 4 to 5. Even during the COVID crisis, similarly, the cash reserve ratio was decreased from 5% to 3%. Again, the money multiplier should have increased, but what actually happened was it decreased from 7 to 5. So clearly, this particular prediction of the monetary theory is completely at dissonance with what we observe in the real world.
Okay. So in that case, what should be the correct, or what is your theory of money multiplier?
So I think it's important to take a step back and ask the question, why is it that the theory of the money multiplier does not work? And that is where the framework that we develop becomes very important. Here it is really important to understand that the theory of financial intermediation, which underlies a lot of monetary theory, treats banks as financial intermediaries. It's like, thinking about them as basically they take deposits and then use those deposits to give loans. That is in some way like passing the parcel. Yes, monetary theory and financial intermediation does talk about liquidity transformation. So, banks take liquid deposits and converted them into illiquid assets. It's as if they take basically liquid milk, convert it into ice cream, but it's still passing the parcel is basically how the current theory thinks about. Now, actually, if you think about how it works in the real world, banks are money creators. They're creators of money. They're not just intermediaries. And let's understand this conceptually. For instance, if I were to borrow 1 lakh rupees from you, Lata, what you would do is basically you would write me a check, and your deposit would come down, my deposit would go up. It basically just passing the parcel. You pass the parcel of 1 lakh to me, it came from your hands to mine. That's the way it works when lending happens between individuals. But that is not how lending and deposit creation happens with banks. If I approach ICICI Bank for a 1 lakh loan, they look at my credit, and they decide to, let's say, sanction a loan. When they sanction the loan, what they're doing is they're actually depositing 1 lakh onto my bank account. So it is the approval and the sanction of a loan of 1 lakh that is increasing the deposit. So loans create deposits. And this is extremely critical. We actually use the demonetization in India as a natural experiment to provide rigorous evidence that it is not deposits that create loans, but actually it is loans that create deposits. We provide other evidence as well. So I think this is really critical to understand. In some sense, therefore, the Reserve Bank, which basically creates primarily the cash that we carry in our pockets, that's a currency in circulation, that accounts for only 15% of overall money supply in the economy. In contrast, banks, the deposits that they create, that accounts for 85% of money supply. And they are the money creators. And actually, including this year's Nobel Prize, the monetary theory gets this part wrong by treating banks as passing the parcel. They're actually creating money.
Okay, that's very important. It's not Lata's money that goes to Subramanian. When Subramanian takes a loan, bank creates a fresh deposit. So,
exactly.
The loan creates its own deposit. But,
Yes.
central banks also create money. When they buy dollars from the system, they are printing money. So, can you just explain that? Central banks also create money. Banks also create money. How does the two work?
So the technical term, that is used for the money that is controlled by the central bank is what is called the monetary base. While the overall money supply basically is the currency, in circulation plus the deposits. As I just mentioned, about 85% of money supply in the economy is created by banks. The central bank, of course, eventually, whether it comes through, through foreign currency or others, basically, it does increase money supply in the economy. But primarily, the control that the central bank has is on the monetary base. And the monetary theory tells us that the monetary base multiplied by that money multiplier is basically what is equal to money supply. Now, as I just explained, the money multiplier does not work. Conventional monetary theory is, it depends on the notion that by cutting the reserve ratio, the central bank can increase the money multiplier, thereby increase the money supply, or they can increase the monetary base itself, thereby increasing the base on which the multiplier works and increases the money supply. But in reality, what happens is these are basically two different. The central bank is creating the monetary base, controlling the monetary base, while the banking sector collectively is basically deciding the amount of deposits through the loans in the economy. And this is really important to understand. So effectively, it is the banking sector that is actually the biggest money creator. And current monetary theory gives far more power to the central bank than there is in reality. One more point to understand this, which is if you take cash, cash basically is the demand that there is for cash in the economy. That is what the central bank creates. And as we will move more towards digital money, fintech, etc., that demand for currency will actually decline. In contrast, we take India in the banking sector. Just 1 in 7 people in India, citizens actually have a bank loan. So there is huge demand-supply mismatch, and the supply, increasing that supply can increase, money supply in the economy. In other words, the banking sector is an active money creator, while the central bank is basically a passive money creator because it is just catering to the demand for currency. Again, this is important to keep in mind when we think about actually monetary policy in the economy. Bottom line, what we are saying is we need to really focus on the banking sector because they are the primary creators of money in the economy. And the notion that the central bank can actually, really affect money supply through either the money multiplier or the monetary base is not right, because they're two, dancing to two different tunes.
Okay, we are trying to put the relevant portions of your book while you were talking. And from the book, of course, we have used the word M0 and M3. So just to explain to those of you who obviously haven't read the book, when Dr. Subramanian is speaking about monetary base, the central bank created money, that is M0, but the bank created money will be M3. The current monetary economics tries to relate the two and says that M3 is dependent on M0. What Dr. Subramanian is telling us, that it is actually an independent variable and it depends on the risk appetite of the banks and the borrowers. Okay, now
exactly. And just to add,
go ahead.
Just to add, Lata, this is, see, both of us worked as bankers before becoming academics. And one of the things that strikes us, anybody who's worked in a bank knows that the lending division basically just goes and lends, assesses the borrower's, credit and goes and lends. It's not as if the lending division waits for, the deposits to come from the, those that basically bring the deposits. They are doing the decision on the lending, and importantly, as loans increase, basically, if the bank gives a loan of 1 lakh to me, it's creating an asset of, the loan of 1 lakh is also simultaneously creating a deposit of 1 lakh, thereby increasing the balance sheet. And this is really critical to understand that banks are the biggest money creators in the economy. Just a small, correction. M3 does include, the part of the monetary base as well. But it's just that M0 and M3 are walking in completely different tunes. And it is, the banks that create the M3, primarily the money supply in the economy. So the power that we've given to the central bank, supposed power, is actually non-existent.
Okay, got that. Dr. Subramanian, we have to take a quick break, but there are other theories. I mean, after all, the central banks around the world have pushed in a lot of money into the system, as you point out. Why is that not getting lent? You correct our way of thinking about central bank created reserves and money supply. We will come to those questions in just a minute after this break.